Traditional IRA, Roth IRA, how do you know which one to choose? Is it really that important? It actually could be extremely important. So stay with me and I'm going to walk you through some tips so you choose the right one. Okay, for starters, I'm going to go over some basics, but stick with me because there's some important things here, but I want to make sure we understand right up front what this is. But I'm going to get through this quick because I want to get to the point of this and give you the information you need. But the main thing is a traditional IRA is deductible. So what that means is that it lowers your adjusted gross income, which is really, really critical for what I'm going to talk about a little bit later, and lowers how much your income tax you're going to pay. The downside is when you draw the traditional out later on in retirement or later on period, you'll have to pay tax when you pull it back out. The Roth, on the other hand, you don't get any tax deduction for it. And that doesn't sound like a great deal, but it really, really is, because when you contribute to a Roth, once you pull it out down the road, there's no tax on it. But today, I want to focus really on the tax implications beyond just tax. And we'll talk about the strategy of Roth and traditional, which one you should do at a later point. As a general rule, I'm going to go Roth most of the time. But there's some really, really important cases where it can make a substantial difference. So I want to get into those right now. Number one, on why you should choose a traditional instead of the Roth. IIRMA. IIRMA is when the government says, hey, you know what? You make too much money. Your adjusted gross income went above our thresholds. And because of that, you are now going to have to pay more Medicare next year. Well, they're looking at your adjusted gross income. And this is a case where a traditional IRA could be a really good decision for you, because if you contribute, that lowers your adjusted gross income, which then would help maybe get you below that number so you won't have to pay an additional IIRMA next year. And if you're married, you can both contribute. Now, of course, you have to have income, earned income, in order to be able to contribute. But if you do, this could be a very, very important strategy that might even make the IRA contribution almost free because of how hard you can get hit on IIRMA. Not free, but really lower the implication. So that's something, if you're looking at maybe owing on IIRMA next year, right now, while you still can, contribute to a traditional IRA, lower your AGI, and that's a really good tip for you. Another thing that I see where you should probably do a traditional instead of a Roth is if you're on the Affordable Care Act or Obamacare and your income is set you so that you're going to have to pay a lot of your Affordable Care Act premiums back. That amount that you got paid in advance, they say, you made more than you thought you were going to make, or more than we put down because your insurance agent maybe made a mistake, maybe didn't communicate, maybe you got a raise. I don't know. Whatever happened, your tax guy just called you up and said, hey, you're going to have to pay a lot of that back. One of the things a lot of people don't realize is if you can contribute to an IRA and drop down one of those levels on the payback, it could save you a ton of money. A ton. I've seen some cases where it almost made it free to contribute to the IRA. So that's not only are you lowering the payback, but you're giving yourself money that can grow inside of a qualified plan. It's a win-win and a really big strategy that I've used a lot of times to save people tremendous amounts of money. So if that's you and you're looking at a payback, definitely go traditional. Another thing that you can use on these same things, you could also contribute to your HSA. So we could potentially do a traditional and an HSA, get ourselves down and save a ton of money, because in some cases, I've seen people who owed $20,000 back on the Affordable Care Act, and by doing some contributions to an IRA, we dropped below the number, and all of a sudden it only went down to maybe $2,500. I don't remember the exact numbers now, but really, really, really important, and so many people don't know they can do this. I want you to know it. The purpose of me here is to try to give you things that are going to help you and save you money, save you taxes, and hopefully help build your wealth too. So that's that. Another reason I might consider the traditional over the Roth, and that would be if you're in a higher tax bracket, which you can't be too high because you can't qualify to even contribute. But if you're in a tax bracket and maybe I can drop down a bracket and it'll save me some money there, that could be a reason. A lot of that's going to depend on your entire financial plan scenario, so I can't really say that in a video like this. I mean, if I'm dropping from a 12% to a 10%, is that really worth it? Probably not. If that's the bracket we're in, I'm probably going with the Roth myself. So when we get into the Roth versus traditional from other reasons, it's a lot bigger strategy, and we'll do that in later videos. But I want to make sure you guys are aware of these opportunities. Same thing for you self-employed guys, is we can do the same kind of thing with your SEP contributions, and we can do that all the way up until the filing deadline. Same thing with these IRAs. The IRAs, we can do all the way up until April 15th. But if you have a SEP IRA because you're self-employed, we can do that one all the way up until the time we file your return in October. So a lot of advantage there for a self-employed guy. Don't ignore this. This could really make a big difference for you. And so that's that. Now, one last thing on this. Be very careful. I had one today. Don't contribute to these IRAs without talking to your financial advisor about your adjusted gross income. I had one just today. He contributed to a Roth. He made too much money. He made like $250,000. That's well above the threshold. Didn't qualify. And same with his wife. His wife contributed to the traditional, thought they were going to have a deductible IRA. Once again, they made too much money. It wasn't deductible. I don't remember their exact amounts, but this is really, really important. Pay attention to the income limits. Look it up. They're available online. You can go to anywhere and find out what the IRA contribution limits are and see if you qualify. Because if you don't, now we've got a non-deductible IRA. When you were trying to do a traditional, we got a non-deductible one, and that can complicate some things down the road when we try to do some other advanced strategies, such as maybe backdoor Roth. On top of that, if you did a Roth contribution and you didn't qualify, now we got to get it back out. And if we don't do this right and we do it quickly, we could end up with a 6% excise tax. I believe it's 6% excise tax until we get it fixed. So not only did we not qualify, but now we're paying taxes because we made a mistake. And you got to go through the headache of getting it fixed. And I'm telling you, if your income is up in the thresholds where you're potentially going to get phased out, wait till you do your tax return in some cases to make sure you're going to be okay, or at least coordinate your tax man and your investment guy to make sure that you don't mess this one up, because it's just a pain and you don't want to deal with it. So that's it. Hopefully that's going to help. We've got a few days left before tax season. Contribute to these IRAs. Choose the right one for you, a Roth, a traditional. They're both great. They just have to be used in the right situation. And hopefully that was helpful. If it was, please go ahead and subscribe. We're a small channel. We're doing this to try to help you. And thanks again. Hit the bell. Appreciate it. You guys are great.